Hello everyone, my name is Rochelle Snitchler and this is a personal finance project on yield curve and investing. Many people say that when you look at the past, you can predict the future. We can look at what has happened in history and learn from the events that have happened in the past to prevent catastrophic events from happening in the future by learning to understand the signs that all lead up to an event. The same is with understanding investment opportunities as well. As we've studied the past few months, we've noticed it's much smarter to invest while we are young than to put it off until we are older. We've seen from many charts, such as 14.1 in our text, that it's smarter to invest when we're young rather than when we're older. And it would not be wise to be putting it off. The same is with understanding opportunities in investments. And we can use this to have hindsight and future predictions. So that way we can invest for the best and we can even be able to predict history, the future history. And here's how looking at yields can be wise in both short-term and long-term bonds and predict the future to avoid recession. So, this is what we're going to be looking at. We're going to be looking at what is a bond. We're going to define what a yield is. We're going to look at some investment prices of bonds and the types of bonds that I'll be focusing on. And then finally, understanding yield curve and investing. First off, what is a bond? A bond is a method in which companies can sell their investor loans as methods in making money. Investors can then purchase bonds and the companies can pay them back over time. A yield is the rate of return that an investor receives over the course of time. The yield is determined by the price in the bond, whether it increases or decreases in value. Short-term bonds, their investment profit can be determined on its market value before and after its maturity date. Bonds, depending on if they're short-term or long-term, municipal, or whatever they may be, all have different costs depending on the company's economic standing, its profits or lack thereof, etc. An example would be TIPS, which is a Treasury inflation-protected security. It has the lowest investment possible, starting at $100, and it goes up in increments of $100. And that can be seen on page 365 of our text. 3 different types of bonds we'll be looking at. Government bonds, which our text describes as written pledge of a government or municipality to repay a specified sum of money. We're going to be looking at short-term bonds, which are defined by a bond that matures in a very short amount of time, and then of course long-term bonds, which mature in a very long period of time, usually between 10 to 30 years, and different kinds of each of these types of bonds. Government bonds are backed by full faith of the government and are considered one of the safest bonds to invest in as the government is stable and low risk. Government bonds are also low risk because of the paying power of the government and how it's very likely to not be able to pay back any bonds that have been purchased. Short-term bonds are, of course, have a short-term maturity rate, but they're also very commonly underneath governmental bonds as well. We have an example would be T-bills or Treasury bills. They have maturities of less than a year in certain of week increments. At payout, the government pays the full value of the T-bill, and then the profit the investor receives is the interest that they receive each month or semi-annually, depending on how long that short-term bond is, or that T-bill. Treasury notes have maturities of 2 years, 3 years, 5, 7, and 10 years. And the longer they are, the higher maturity rate. Also the higher interest and the higher yields that they receive. Another kind of short-term bond are high-yield bonds or junk bonds. Long-term bonds, like I said, are defined by having a longer period of maturity, usually between 10 to 30 years. And an example of some would be treasury bonds, which have maturities of 30 years, and the interest is every 6 months with higher interest from having higher maturity. Treasury inflation-protected securities, or TIPS, like I mentioned earlier, are 5, 10, and 30 years, both a short-term and a long-term bond. Understanding yields. Government yield bonds are, an example of such would be the treasury bills. In most cases, yield curves will move upward in a direction when the economy is trending upwards, especially with the longer duration a bond as it takes to mature, and the smaller yield when a bond is short-termed. In the case of an inverted yield curve, we see that the short-term bonds actually have a higher yield than the long-term bonds. And this is when investors actually have low confidence in the economy, when they think that it's best to invest long-term than short-term, because investors believe that the economy will not be doing well in a short term, at least in a few short years. So as we see right before the economic downturn of 2007, 2008, in July 2016 or 2006, the 3-month yields were much higher than the 10-year yields. And this isn't because more people are purchasing the short term, but rather that they're not purchasing them. So this is what it should be. 3 months should be much lower yield than the 10-year. Looking at another kind of indicator in understanding yields would be a high yield versus treasury. And we have right here in with Bloomberg, we see that, which is actually pretty opposite of what should be common, is that so high yield curves will actually go upwards when the economy is doing really well, which, I mean, you know, that's not very surprising when we see things going in an upward direction. But when the economy is doing really well, treasury rates will actually go down, because right now our economy is doing fairly well, and this is when treasury rates will go down. So that's kind of a curveball that happens in our curve of yields. Long-term yields and their clues. I took a look at some Vanguard long-term equity funds from, of course, from the website Vanguard. As you can see in this chart, we can see that there were some stagnant economic times for a few years, and then it just plummeted. And it doesn't look like it's a lot, but considering it how steady we've been on an increase ever since 2008, it looks like that's pretty drastic for how long of a stagnant time it was, at least for Vanguard when they were recording this this time. And this is October of every year. And since then, it's stumbled a few times, the economy has, but it's still been a pretty steady climb over the past decade. So now we're going to look at why should we even discuss the types of bonds. See, government bonds are one of my focuses that we're looking at in order to understand the future and recessions and how to prevent recessions is because government bonds have very, very high stability because of the government of the United States and the United States Treasury. When investors start losing confidence in the U.S. Treasury, there can be trouble brewing. Short-term bonds tend to be very popular when it comes to wanting a safe way investing of money. So those who like to invest in smaller amounts receive profit through interest in a short amount of time, but they're more likely to continue purchasing. So when investors aren't wanting to invest in short-term bonds, especially because they're so low risk, it's meaning that they don't really have a lot of trust in our economy if they're not wanting to invest in short-term bonds. Long-term bonds can also be a great indicator because more investors are willing to invest long-term and nobody's investing short-term because they're saying that the economy could go really bad in the next few years, so it's much better to invest in the long run and hopefully have money in 10 to 30 years. And especially because the long terms are higher risk and more people are going towards the higher risk. So we've looked at different signs of economic downturn. We've established from looking at yield curves for these different kinds of bonds. Government bonds of treasury bills show inverted yield curves, which means higher yield for short-term and lower yield for long-term bonds. And then for short-term bonds, less people are investing in short-term and less people are investing in short-term and more people are investing in long-term because they're more confident in receiving profits from long-term maturities than rather short-term. And then for long-term, because we have such at least looking through Vanguard, we can see such a long period of history that we can continue to see the economic upturn when it starts going down. It's not a very good sign. So our conclusion, we have now taken a look at different types of bonds that are most commonly invested in, such as government bonds, short-term bonds, and long-term bonds, and why they're so important due to the desire for investors to choose. We've looked at the yield curve and how they can be observed by investors and even non-investors because I've never invested and now I can see that it's a great indicator of how the economy is doing. We can also see the specific signs in yield curves for each of the governmental, short-term, and long-term bonds and how they serve economic warnings. So I've also left a slide so you can see my sources. These are all the different websites I had gone to either just to find a new direction and to get some extra help. Anyways, I really enjoyed this class and I appreciate Handy's online classes and everything. So I hope that you learned a little bit. Maybe you caught something that you didn't caught in class before. And I hope you enjoyed this class as well as I did. So, yep. Have a Merry Christmas or Happy Hanukkah, Happy Holidays, whatever you celebrate.